In 2026, a fixed-rate mortgage can still jump by about $134 a month when an $800 escrow shortage gets stacked on top of higher property taxes and homeowners insurance. That is more than $1,600 a year coming out of the same checking account you thought was protected by the word fixed. If your budget already has groceries, gas, daycare, car insurance, and retirement contributions fighting for space, one mortgage notice can force a cut immediately. By the end, you will know why the payment jumped, what escrow is doing behind the scenes, and what to check before the next analysis rewrites your housing budget for you. Put a real household behind that number. A couple buys a $320,000 home outside a mid-size U.S. city. Not a mansion, just a normal place with a driveway, a kid's room that doubles as an office, and a mortgage payment that was supposed to be boring. They use a 30-year fixed loan at 6.75%. Their principal and interest payment is about $2,076 a month. At closing, the lender estimates property taxes at $3,600 a year and homeowners insurance at $1,800 a year. So escrow is $450 a month. Total payment, $2,526. That is the number in the spreadsheet. That is the number that decides how much is left for Costco, preschool, student loans, car repairs, and maybe a little automatic investing so future you is not forced to survive entirely on hope and Social Security headlines. Then the annual escrow statement shows up. The interest rate did not change. The loan term did not change. Nobody missed a payment, nobody refinanced, nobody bought a boat, but the monthly payment is suddenly higher. This is where homeowners feel like the mortgage industry is doing card tricks with their checking account. Because when most people hear fixed-rate mortgage, they hear fixed monthly payment. That is the emotional contract. You agree to pay a huge bill for a very long time, and in exchange, one part of adult life is supposed to stop moving around. But the system does not promise your total payment stays fixed. It promises your principal and interest stay fixed. Those are not the same thing. Your mortgage bill usually has three big pieces. Principal pays down what you borrowed. Interest is the bank's price for lending you the money, because apparently Shelter requires a 30-year subscription plan. Escrow is the bucket your lender uses to collect money for property taxes and homeowners insurance. On a fixed-rate loan, principal and interest usually stay steady. The escrow bucket does not. Escrow is tied to bills that move. Your county can reassess your home. Your city can raise a tax rate. A prior owner's exemption can disappear. Your insurer can renew your policy at a higher premium because roof repairs cost more, weather losses are uglier, reinsurance is more expensive, or your zip code suddenly looks less cute to an algorithm. And the lender does not absorb those increases for you. The lender pays the tax bill and insurance bill out of escrow, then adjusts what it collects from you. Escrow is not a random fee invented in a conference room called Ways to Annoy Homeowners. It is a prepayment system for bills you already owe. But because it is folded into one mortgage number, it feels like the mortgage changed. Here is how the shortage happens. At closing, the lender estimates your annual tax and insurance bills, divides by 12, and collects that amount monthly. If taxes are $3,600 and insurance is $1,800, that's $5,400 a year. Divide by 12, and escrow is $450 a month. Then the real bills arrive. The county reassesses the home, and the tax bill rises from $3,600 to $4,200. That is $600 more. Homeowners insurance renews at $2,000 instead of $1,800. That is another $200. Together, the bills are $800 higher than the lender planned. Now, the escrow account has two problems. First, it was short for the year that just happened. The lender collected based on the old estimate, but the actual bills were higher, so there is an $800 shortage. Second, next year's bills are now expected to be higher too. The lender cannot keep collecting $450 a month when the new tax and insurance estimate is $6,200 a year. Divide $6,200 by 12, and the new ongoing escrow need is about $517 a month. So escrow rises by about $67 a month just to cover the higher future bills. But that does not fix the old $800 shortage. If the servicer spreads that shortage over 12 months, that adds about $67 more per month. $67 for the new reality, $67 for last year's under collection. Now your payment is up about $134 a month, even though your interest rate did absolutely nothing. That is the part homeowners miss. The pain is not just the higher tax bill or just the higher insurance bill. The pain is the stacking. You are paying for higher expected bills going forward, while also paying back the shortage from the old estimate. Some servicers give you a choice. Pay the shortage in one lump sum or spread it out over the next year. The lump sum hurts now, the monthly spread hurts every month. Lovely menu. Would you like the financial headache in one serving or 12? This is why the annual escrow analysis matters. Once a year, your mortgage servicer reviews the escrow account. It checks how much it collected, how much it paid for taxes and insurance, what it expects those bills to be next year, and whether the account needs a cushion. The cushion is a small buffer so the bucket does not run dry before the next tax or insurance bill arrives. From the homeowner side, that buffer can make the payment jump look even more confusing. You see one new monthly number. Inside that number may be higher projected taxes, higher projected insurance, shortage repayment, and cushion. 4 moving pieces, one ugly total. That is why people say, "My mortgage went up." Technically, the loan repayment may not have gone up. The total housing payment did. That distinction matters because the fix depends on the cause. If principal and interest changed unexpectedly, you may have an adjustable rate loan, a recast, a servicing issue, or something else that needs direct attention. If escrow changed, you need to trace taxes, insurance, shortage repayment, and cushion. Start with property taxes, because this is where a lot of buyers get surprised. Property taxes depend on local rules, assessed value, tax rates, exemptions, caps, and budget decisions from counties, cities, school districts, and other local authorities. Very glamorous. Nothing says home ownership like discovering the school district budget has entered your checking account. If you bought recently, you may have seen the seller's old tax bill and thought, okay, taxes are about $3,600 a year. Then after the sale, the county reassesses the home closer to the new purchase price. Suddenly the bill is $4,200, $4,800 or more, depending on the market and local rules. Sometimes the jump hits after the first year. Sometimes a temporary cap or exemption belonged to the prior owner and does not carry over. Sometimes a homestead exemption was missed. Sometimes the assessed value is just wrong. Escrow does not care that you were budgeting from the old number. It pays the bill and adjusts later. That is how a $600 annual tax increase can become more than $50 a month for a while. You are not only paying the new $50 going forward, you may also be repaying the undercollection from the previous year. Now look at insurance, because insurance is becoming the faster-moving piece in a lot of households. Homeowners insurance used to feel like background noise. You got a quote, signed the closing paperwork, and mostly forgot about it unless a tree fell on something expensive. That era is getting harder to recognize. The average annual cost of homeowners insurance is projected by some estimates to reach roughly $3,057 by the end of 2026, up from about $2,948 in 2025. Since 2021, average premiums have risen around 46%. Averages are not destiny. A homeowner in Ohio is not the same as a homeowner near the Florida coast, in wildfire country, or in a hail-heavy part of Texas. Some people will see smaller increases. Some will see much larger ones. Some will get dropped and have to shop in a tighter market. But the direction matters. When insurance rises, escrow rises. And insurance can move for reasons that feel completely detached from your personal behavior. You did not file a claim. You did not set your roof on fire. You did not personally invite a hurricane to the subdivision. But insurers price risk across markets. Severe weather, higher labor costs, more expensive materials, legal costs, rebuilding costs, and reinsurance all feed into premiums. For a 30-something household, this hits in the least convenient place possible: monthly cash flow. You were not reading an abstract insurance report. You were deciding whether the extra $134 a month comes from dining out, a streaming bundle, the kids' summer camp fund, emergency savings, or the money going to your Roth IRA or 401k. And this is where online financial advice can get embarrassingly detached from reality. Someone will say, just invest more. Great. With what? The couch coins? If your housing payment jumps by $134 a month, that is $1,608 a year. For a household already dealing with higher car insurance, groceries, utilities, and credit card rates, that is not a rounding error. So do not start with panic. Start with the breakdown. When the escrow notice arrives, the new total payment is the scary number, but it is not the useful number. First, find principal and interest. If you have a fixed-rate mortgage, that portion should usually look stable. Confirm it.
Second, find what the servicer actually paid last year for property taxes and homeowners insurance. Third, compare those actual payouts with the new projected amounts. Fourth, look for the shortage. It may say shortage, deficiency, escrow shortage, or required balance. Fifth, check the repayment period. If the shortage is spread over 12 months, divide it by 12. Sixth, look for the cushion. Now you can label the increase. Maybe taxes are the main driver. Maybe insurance is the main driver. Maybe neither one is huge alone, but together they created a shortage. Maybe the number looks terrifying because it includes a one-year repayment that could disappear later, assuming new bills do not jump again. That last assumption is doing some work, obviously. Next, call the servicer and ask for payment options in dollars, not vibes. Ask, what is my payment if I pay the shortage in full now? Then ask, what is my payment if I spread the shortage over 12 months? Then ask, how much of my new payment is shortage repayment and how much is the ongoing escrow estimate? Paying the shortage in a lump sum might lower the monthly payment, but it also drains cash. If your emergency fund is $1,200 and the shortage is $800, paying it all at once could leave you one car repair away from credit card debt. On the other hand, if you have a strong cash cushion and spreading the shortage would push your monthly budget into the red, paying it up front might be cleaner. This is not about finding the morally superior option. It is about choosing the version that does the least damage to your actual household cash flow. If spreading the shortage makes your monthly budget negative, cut or replace something immediately, not spend less. That phrase has never paid a bill. If the escrow jump is $134 a month, find $134. Maybe that is canceling unused subscriptions, moving one restaurant night to a grocery meal, switching a phone plan, and buying a few store-brand household items for the next 12 months. Maybe it is delaying furniture, pushing a vacation deposit, or pausing extra principal payments while you rebuild the buffer. Be careful with retirement contributions. Do not casually stop getting an employer match because escrow got annoying. If your employer matches your contribution, that match is part of your compensation. Cutting below the match can be an expensive way to solve a short-term cash problem. If you have to reduce investing temporarily, make it deliberate. Write down the trigger for restarting and protect the match if you can. Now, insurance. If your homeowner's insurance premium jumped, shop before renewal, not after the escrow analysis has already swallowed the increase. But do not chase the lowest premium like you are buying paper towels. Compare deductibles. Compare wind and hail deductibles. Compare roof rules. Compare replacement cost versus actual cash value. Compare exclusions for flood, sewer backup, wildfire, mold, and ordinance or law coverage. Make sure the dwelling limit reflects rebuilding costs in your area. A cheaper policy with a giant deductible and worse roof coverage can save $40 a month right up until it costs you thousands after a storm. Ask an independent agent to quote multiple carriers if your market has options. If carriers are pulling back in your area, start earlier. Give yourself weeks, not days. Only raise your deductible if you have the cash to handle it. A $5,000 deductible is not clever if a $5,000 claim would immediately become credit card debt. That is not insurance planning. That is moving the problem to a future version of you who will be equally annoyed. Also check bundling, but do the math. Sometimes bundling home and auto saves money. Sometimes one company wins on home and another wins on auto. Loyalty discounts are nice, but loyalty to a bill that keeps climbing is not a personality trait. Now taxes. If property taxes jumped, pull the actual assessment notice. Do not just stare at the escrow statement. Check the assessed value. Did the county overstate square footage, finished basement space, lot size, or improvements? Are comparable homes assessed lower? Did you miss a homestead exemption, senior exemption, veteran exemption, disability exemption, or local relief program? Every state and county has different rules, deadlines, and appeal windows. Annoying, yes, but the deadline is the key. A legitimate appeal filed late is often just a document-shaped regret. If you bought recently, ask whether the old owner's exemptions were removed and whether you need to apply for your own. In some places, homestead exemptions can reduce taxable value or limit future increases, but they may not happen automatically. And if you are shopping for a home, do not trust the seller's old tax bill as your future tax bill. Ask your agent, lender, or local tax office what the bill could look like after reassessment at your purchase price. Get current insurance quotes before you fall in love with the monthly payment estimate. Ask about roof age, flood zone, prior claims if available, and local insurance availability. Because the first monthly payment estimate can be a little too polite. It may show you the house as if taxes and insurance will behave themselves. Then year 2 shows up with a clipboard. The bigger lesson is that home affordability in 2026 is not just about the interest rate. Rates matter, obviously, but once you own the home, the fixed rate is only one piece of the monthly payment. Taxes and insurance can turn the fixed payment into a payment that still moves, because home ownership is tied to local government budgets and insurance markets, not just your mortgage note. This is why escrow increases feel so personal. You did the responsible thing. You locked a fixed rate. You bought within a payment you could handle. You paid on time. Then the county reassessed, the insurer repriced, the servicer recalculated, and suddenly your budget gets treated like it has extra room, and maybe it does not. So build a separate escrow buffer outside the mortgage account. Not a huge, complicated fund with a name that sounds like a hedge fund, just a savings bucket. Take your annual property tax plus annual homeowners insurance, then add 10% if your area has been seeing increases. Divide by 12. Compare that number with what your lender is currently collecting for escrow. If your estimate is higher than the lender's number, save the difference in a separate high-yield savings bucket if you can. For example, if your lender collects $450 a month, but your updated estimate says taxes and insurance are likely closer to $517 a month, the gap is $67. If you can set aside that $67 before the escrow analysis, the next shortage is less likely to wreck the month that arrives. If $67 is too much, start with $25. The point is not perfection. The point is not being completely shocked when the bills catch up. And review insurance before renewal, not after. Put a reminder 60 to 90 days before renewal. Do the same with tax notices. When the county sends an assessment, read it. Check appeal deadlines. Confirm exemptions. Save the notice. Then, when the escrow statement arrives, you are not trying to decode a year's worth of local government paperwork at 11:30 p.m., while your mortgage app displays a number you do not like. Also, save each annual escrow statement. Put them in one folder. Compare year over year. Look at taxes, insurance, shortage, cushion, and monthly collection. In 5 minutes, you can see whether the problem is a one-time shortage repayment or a trend. That distinction is huge. A one-year shortage repayment may require a temporary budget adjustment. A recurring insurance surge or reassessment trend may require a more permanent change. Bigger cash reserves, different coverage strategy, a tax appeal, or a serious look at whether the house still fits the budget. Nobody likes that conversation, but avoiding it does not make the ACH draft smaller. The most dangerous phrase in this situation is, "It is only escrow." Escrow is not imaginary money. It is your tax bill and your insurance premium converted into a monthly collection system. If those bills keep rising, escrow becomes the place where the pressure shows up. And for millions of homeowners, the pressure is landing at the same time as every other adult bill. Groceries are still not exactly nostalgic. Car insurance has not become charming. Utilities keep doing their seasonal surprise routine. Credit card interest is still very committed to being rude.
So when the mortgage payment jumps, the answer is not denial. It is a breakdown. Separate principal and interest from escrow. Find the tax increase. Find the insurance increase. Find the shortage. Find the repayment period. Find the cushion. Then decide whether to pay the shortage up front or spread it out. Shop insurance with coverage details in hand. Check the tax assessment before the deadline, and build a separate buffer for the next cycle. That is how you take the power back from a confusing statement, not by pretending the fixed rate mortgage fixed everything. It did not. A fixed rate protects the loan payment. It does not freeze property taxes. It does not freeze homeowners insurance. It does not freeze the cost of rebuilding a roof, the county's assessment process, or the insurer's risk model. The homeowner who understands that early gets options. The homeowner who waits for the new payment draft gets a surprise.
And in 2026, with insurance premiums still elevated and tax reassessments hitting household budgets, the difference between those two homeowners may be one escrow statement, one phone call, and one savings bucket opened before the bill decides for you.